Good afternoon, good evening, good morning, and welcome to the Business Diary. In this episode, I have a conversation with Stever Robbins. He has been a business person and entrepreneur since the late 1970s. Stever co-founded the early internet success story called FTP Software, and he has been a part of 9 high-tech startups, 3 IPOs, and 3 acquisitions. He was COO for Building Blocks Interactive and a project manager at Intuit, where he led the developing of the award-winning Quicken Visa card. For those of you who don't know, Intuit is also the company that started QuickBooks, one of the world's biggest accounting softwares. He began developing business leaders as part of Harvard's Business School Leadership and Learning Curriculum redesign project, and he has been an advisor and mentor to senior managers in several high-growth companies. He currently serves as CEO of the Stever Robbins company, where he coaches executives and high-potential leaders, and he's also a member of the career coaching staff at Harvard Business School. He's a creator of the pool leadership concept. Stever has written extensively about leadership in his book, It Takes a Lot More Than Attitude to Lead a Stellar Organization, and in his monthly Harvard Business School Working Knowledge column. He's an angel investor, a board member, and advisor to several young companies. Steve has also been a judge for the Harvard Business School Business Plan Competition and the Brown University's Business Plan Competition. He's also served as a mentor for the MIT $50K competition. He teaches high school students business as a junior achievement mentor. Steve holds an MBA from the Harvard Business School and a Bachelor of Science in Computer Science from MIT. He's a graduate of W. Edward Deming's Total Quality Management Program. He's a certified master trainer elite of NLP and a certified executive coach. And for those of you who might not know what NLP is, it's neuro-linguistic programming. He's also appeared widely in the media, including the Wall Street Journal, NBC Nightly News, the New York Times, ABC News Now, MSNBC, Business Week Online, and Investors Business Daily. He has written for the Boston Business Journal and Entrepreneur.com, and he has a monthly leadership column on Harvard Business School's Working Knowledge. In his spare time, Steve's hobbies include swing dancing, Ericksonian hypnotherapy, stand-up comedy, acting, singing, writing, comedy improv, strategy board games, and writing about himself in the third person. He's also learning guitar, so please buy earplugs. So that's all about Stever. I'm going to have a conversation with him about scaling startups and all things business, and I'm just going to be picking his brain on his thoughts and based on his experience, and we're just going to, let the conversation go. So I hope you guys like this episode, and we're going to have a second part as well, so stay tuned. The first question that I'll probably ask, what are the prerequisites, shall I say, for a business to actually start scaling, to get more revenue, to increase their customer base? Let's start with those two things.
Sure. Well, basically, you get more revenue when more people want your product, and that's what drives scale. Now one of the things that has certainly been the case in Silicon Valley in the last several years is that people try to drive scale in a somewhat different way, right? People try to drive scale by saying, hey, let's raise a $50 billion and then just shove marketing and advertising out into the world and into the masses. And hopefully if we do enough advertising, it will stimulate sales and then we can make our money back. Now, that can absolutely work if you know that you have the message and the product that are going to go together and going to bring you the market that you want to do. And of course, that also means spending a ton of money trying to stimulate demand up front. So that's a whole different strategy than organic demand, where you start to grow, people see the clothes that you're producing, maybe you're on podcasts, but you're doing things at a slower pace and you're waiting for the sales to come in. And then suddenly you take a look at your order growth and you go, whoa, at this rate, if we continue to be able to do the type of outreach that we're doing, which isn't necessarily gigantic advertising blitz, we're going to have to start being able to fulfill those orders 6 months from now and 6 months, and we don't have anywhere near the capacity that we need to be able to fulfill what we project our orders to be in 6 months. And that's when you start looking at growth options early. So that's when you start saying, okay, let's be looking ahead and make sure that we're putting in place now what we're going to need in 6 months.
Okay.
Does that, so it's not that you decide, well, you can decide, oh, we're going to grow, but if you don't have the pre-existing demand, to be able to drive that growth, then you need to grow by creating that demand, which is going to mean a lot of advertising and marketing, or really down and dirty hustle type ways of getting exposure, so that you can start stimulating the demand.
Okay. And let's have a conversation about stimulating demand in terms of using digital marketing, because a lot of the Silicon Valley startups that I've read about and observed, they have exponential growth, right? And I mean, I would like to think that probably it's because of the huge amount of funding that they get. But besides that, how are they able to get to unicorn status? How is a startup that is situated in Silicon Valley able to achieve unicorn status in such a short space of time, where they have massive amounts of revenue and a wide customer base?
Well, number one is by sinking hundreds of millions of dollars into marketing and into getting the word out there. But keep in mind, an awful lot of these companies that achieve the unicorn status are not profitable, and they're being propped up by the amount of money that they've raised. And this can go on for many, many years. People still think of Uber and Lyft, for example, the ride-sharing apps, as successful companies. Measured according to what it means to be a successful company, which is the ability to deliver a product or service at a price that the market values and still have enough profit left over to fund your own operations. They fail that test. They are complete failures as businesses. Now, they have raised so much money that investors have been able to walk away with tons of money, and the founders are billionaires, but to me, it's a triumph of evidence that you don't need to create any economic value to be a billionaire, as long as you're at the right place in the financing chain. So, how do they get unicorn status? They're in the middle of an ecosystem where venture capitalists are willing to give absolutely outrageous valuations to unproven concepts that are unprofitable on a per unit basis. And they basically ride those valuations. Now, why the VCs are willing to supply money at those valuations is it may be that they have faith that the number of eyes, the number of users going to the website or using the product is going to expand. It may be, if a company is profitable, that they're doing very reasonable projections and saying, oh, wow, based upon a reasonable set of projections, we believe this is genuinely fundamentally worth X billions of dollars. But a lot of the companies are really being fueled by speculation. They're not being fueled by business fundamentals. And it's going to be interesting to see how that continues in the next few years, since at least the conventional wisdom is that at the moment we're no longer in an environment where VCs are willing to throw arbitrary sums of money after bad ideas. But of course, that said, we just saw some of the top VCs in Silicon Valley invest in FTX, the crypto company, the crypto exchange, which was demonstrably a horrible investment. I mean, like if you simply asked the most basic due diligence questions that a first-year MBA student would be taught to ask, things like, how is this company going to spend money? And then discover that they didn't even they didn't even have accounting systems. The notion. So basically, you have a bunch of venture capitalists that are either so excitable or so sloppy that they're not even noticing that they're investing in companies that don't have accounting systems. And because however they're investing, it's not on the basis of fundamentals, it's on the basis of storytelling. A lot of these companies are able to tell these stories, which are getting the venture capitalists very excited and willing to invest at valuations that create $1 billion unicorn status valuation. But if your goal is to build a business that is making money and can be grown in the future, versus I want to be a unicorn, which means I have $1 billion valuation and I want to do that in 6 months. Those are two very different businesses. And I will suggest, and I'm sure there are people who will argue with me up one side and down the other, but in my point of view, the notion of getting to be a unicorn company without showing that you can deliver a product or service at a profit, I think all you're doing is trying to game the financial situation, the financial system, which is, again, there are people who have done that quite successfully, but that's not a business. That's gaming the finance system, and then walking away with the money, leaving someone else holding the bag. I'm pretty sure that's not the answer you wanted.
I mean, that's quite a mouthful. Okay.
Yes.
You mentioned something about, the things that a first year MBA is supposed to assess. What can you say about the personal traits that a person must have for them to operate a business that is going to stand the test of time, that goes, beyond 10 years, beyond 20 years? We're talking about intergenerational businesses.
Sure.
What are those traits that a manager or a CEO or an executive must have? Because a lot of these startups, for example, or not a lot of these startups, but a large number of startups that I've seen in Silicon Valley, for example, are started by, university dropouts or people that, didn't attend university at all. To what extent is that technical skill that people learn in university important when it comes to building sustainable businesses that grow over time?
There are a number of different skills, and it's certainly possible to learn these not have any formal business education. There are books you can read that will go through all of this, and but a lot of people may or may not read the books, and whether they do read them or don't read them, they may not put them in, or sorry, whether they do read them, they still may not put them into practice. But number one, unless you are very lucky to find a business that is so ridiculously profitable that it will always generate enough money to cover your cash flow, you do need to eventually learn how to read an income statement and how to manage to the numbers. You need to know if you're making money, if you're making money, if you're losing money, and what the trends are, because you might be making money this month, but you may be making less than you made last month on a higher level of sales. So what does that mean? What that means is that you may be making less and less money, or more and more money. And you need to know, is that because you're becoming more or less profitable, or is that because you are keeping the same profitability, but you're gaining or losing market share, or some combination of the two of those? So you need to be able to have and again, I'm talking about what will make a business enduring over time. You need to be able to understand enough about the numbers that you can interpret the way that sales are happening and what's going on in a way that enables you to then fix the business if it runs off course. One of my favorite examples of this is restaurants. I have seen a number of restaurants open in cities where I've lived, and then they go out of business 5 years later. And they're just amazed. Why did I go out of business? And the answer is really simple. It's like, your food wasn't very good. And it's amazing that they survived for the 5 years. But what they needed to do was take a look at the numbers and say, wow, we're not gaining any market share. People who are showing up aren't coming back very often. So let's ask them why. And let's see if we can come up with a combination of our product and service and cost structure that enables us to make a profit and grow. And if they had talked to certainly me as a customer and said, why haven't you come back, or why don't you come back more often? I would have said, because your food is not very good. And there's a place just down the block that has better food at the same price. So another piece that I think is really essential to create a truly ongoing business, one is the ability to read and respond to your company's financials. You don't have to be a finance expert. You don't have to be a bookkeeper, but you need to know enough about the numbers so that you can detect trends before they become critical, and you have some idea what to do in response to those trends. You also, one of the trends you really want to have pay some attention to is marketing, big time. And I don't necessarily mean marketing in terms of just advertising kinds of marketing. I also mean marketing in the sense of knowing who your competition is, keeping in touch with the market, understanding who it is that you're serving and what it is that they are getting from you that keeps them coming back. And especially if you're talking about intergenerational wealth, the answers to those things may change over time, right? I mean, people, you have a company like, well, this wouldn't be a family business. You have a company like 3M, which is a giant, it's this giant company, but they do a lot of research-based and scientific innovation-based products. And they can't, they need to be up to date on what is the latest science, so they know the direction to send their R&D, but also what is it that people want, so that they can take the latest science and figure out how to design products that solve the needs of people who are likely to keep buying from them. Like I'll tell you, 3M generally has a reputation as being more of an industrial and a business to business type company for like medical things. I am amazed that they have not created a line of the highest quality N95 masks, but done them with fashionable designs, or at least colors other than white. They have the technical capability to do it, and at least in America, the only things that you can get for COVID protection that also look stylish or look interesting are KN95s, which aren't evaluated by our Federal Trade Commission or our Federal Drug Administration. And I'm kind of looking at this going, 3M has the capability to do this. I'm pretty sure they noticed that we've been in a pandemic. It seems like an opportunity that they really let slide. So, now that said, I don't think they're going to go under anytime soon, but you want to be on the lookout for what is it that we can do? What is it that the market wants or needs? And can we adapt either by adding products or by changing the current mix of our products to be the best match for people, for people in our customer base? And that's really basic business skill, which you need for longevity. And then there is the good old, how do you treat your employees and your customers? For some businesses, this matters. For other businesses, it doesn't. Okay. But in something like a restaurant, for example, how you treat your employees is going to determine the kinds of employees you can attract and retain, which will determine how your employees treat your customers, which will determine if the customers want to come back. So one of the things that is supported by research from the Service Management Group at Harvard Business School, I don't think the Service Management Group exists anymore, but it was around for about 20 years, and they specifically looked at service businesses, and they found that with service businesses, the linkage that I just explained really holds true. The way that you treat your employees determines the way that your employees treat your customers, which then determines both the prices people are willing to pay and how often they're willing to come back. So treat your employees well, your employees will treat your customers well, and you will be able to have them coming back and to stay in business much longer than if you treat your employees poorly. So that's another one of the things you want to look for if you're talking about a truly enduring business, as opposed to something that's just going to be financial arbitrage.
And another question, based on what you've just said, there are markets that are very volatile where, obviously startups are in an environment where the conditions are very unpredictable. But if we take it back to more volatile markets where they don't have functioning currencies or a properly functioning economic system, for example, in Southern Africa, my country where I come from, Zimbabwe, right? If you're operating and running a startup, it's as unpredictable as it gets, because you have a currency that doesn't function outside the borders of the country. And also, you need to run a business, and, you have the dollar working there, you have the Zim dollar, there's a parallel rate, and then there's a bank rate, and, the market conditions are as nasty as they get. How do entrepreneurs that are in these spaces get to scale their businesses where even political conditions are unfavorable? How do they kind of optimize processes to kind of suit that environment?
Sure. Okay. So I'm going to make up this answer because I do not have any direct experience in environments like that. So, the best I can do is apply what I know about business and my problem-solving hat and think, how would I do this, or how would I start to do this if I were in that situation? when you have that degree of unpredictability, I think what you want to think about is building very resilient systems. So systems that can survive different shocks. Which are you familiar with risk management?
Yes, yes.
Okay, so basically, I would divide my business into along the different dimensions that I think are going to be unstable. So things like currency risk, things like market risk. If you think that the market may or may not, for some reason, decide yes they want your product or no they don't. Like maybe maybe if you're selling into government agencies and government agencies radically shift their buying patterns with every new administration, which is not necessarily the case in a larger, more developed country, then I would identify what are the risk factors, where are the places that I think have the greatest levels of instability, and then I would start thinking about ways that I could recover from instability or that instability wouldn't permanently damage the company. So let's say, for example, that let's use the example of mask manufacturing during COVID. Let's say that you're creating N95 masks and you're in the middle of a pandemic. So if you're in that situation, you can be reasonably sure that there's going to be demand. But there's a big unknown there. And the unknown is there going to be demand 6 months from now? Is there going to be demand a couple years from now? And in that case, there's a lot of different elements to the business. There's sourcing your raw materials, which is your supply chain. There's distributing your masks. How are you actually going to physically get them to people if you're living somewhere where you don't have a well-established retail channels and all the logistics associated with that. And then, of course, are people going to buy? And I would start working through from day one. I would start identifying what are the possible scenarios. So supply chain. Let's say there are supply chain shocks. What does that imply that we want to do? Do we want to buy a bunch of inventory up front and risk having that inventory be worthless if demand changes? Do we want to limit our capacity and to consciously let go of some of the upside, but then know that in the case of downside, we're not going to be bankrupted?
Yes.
Then in terms of things like distribution and transportation, what are our backup plans if the transportation system that we're currently relying on, let's say that we're currently thinking of shipping things in tankers to wherever it is that who's buying our masks, and the ports get clogged up, as actually happened during COVID. So, I am assuming that that's going to be one of the things that you think about in advance during your risk analysis. And then you're going to go, wow, if something happens to the ports and we can't deliver our product via shipping container, how else could we get it there? Are there nearby railway that we could, again, spend a little bit of money to maybe buy? And I don't know if this is even a thing, I'm making this up, but if there's a way to option the ability to reserve a certain amount of rail capacity in advance, and you have to let it go 4 weeks before you otherwise would need to use it, or something like that, so the railways can still make money. But if something like that exists, if you could buy, in essence, a railway capacities future, which, like I said, they may exist, I just don't know, you might decide it's worth doing that up front to protect yourself against the possibility that the ports will become unusable. So that would be an example of how you would seek to retain flexibility during transportation risk. And then in terms of market risk, which is, what if suddenly a cure is found and people decide they just don't want to wear masks anymore? What are we going to do with our excess inventory? Do we care? And for that comes back to, you might want to limit the capacity of how many masks you produce, knowingly giving up some of the short and long-term upside if the thing should stretch on for years, but in return, you don't have so much exposure that a sudden drop in demand will leave you holding the bag on way too much inventory that you then just have to write off. So to summarize again, the principle behind all of those examples is, if you're someplace where many, many different things are volatile, I would make it a regular practice to identify the different kinds of volatility and to sit down with your team and brainstorm the heck out of how can you hedge against those types of volatility. And, you might still be wrong, but a lot of times there are things like insurance payments or different types of options strategies that will let you take calculated bets and either limit your downside well, and limit your downside, often at the expense of some amount of upside. But I would rather have $5 million in the bank and cap myself at 5 million than shoot for 100 million, acquire $50 million worth of inventory, and then suddenly lose it all. I'm conservative that way. I really believe a bird in the hand is worth two in the bush. So I tend to be big on hedging strategies and taking less money that's certain money, rather than rolling the dice and possibly risking putting myself in a financially untenable position.
Okay. And I was looking at your bio, very long one, by the way.
Well, fortunately this is auditory, but I am older than I look. it's and hopefully you will be someday too.
Yeah, no, that's actually good to see you taking care of yourself. I saw that you were on a team of you're a team member of 4 IPOs and 3 acquisitions.
Yep.
So, I mean, with looking at the processes that are involved when a company goes from start all the way up to IPO, what can you say are the things that these companies that you worked with got right for them to actually be publicly listed? Because for a company to get publicly listed, there's a certain amount of growth that they have to go through. What can you say are the steps that are needed, and also what did they get right for them to get to IPO?
That's actually a very tricky and interesting question, because I don't think it's as simple. I think, number one, there's often a lot of luck involved, which no one wants to admit. But particularly when you're talking about something like going public, some companies go public before they're even remotely profitable. And so, so clearly whatever it is they did to go public is not something that's easily reproducible. Just by anyone. You have to look at what were the things that actually happened there. Sometimes it was that the venture capitalists involved took us public, and sometimes they took us public on the strength of our financials. For example, I was with Intuit, the people who make the software called QuickBooks, and I was with Intuit when they went public, or I guess when we went public. And with Intuit, we had solid financials. We were profitable. We were growing every year, and there were no serious competitors in the marketplace. So not only were we growing, but we were growing very, very rapidly. So that's a powerful story that lets you sell yourself to the markets and get taken very seriously. That's the good news, right? The bad news is it's not at all clear to me how easy that is to replicate, because Scott Cook, the founder of Intuit, he was a Harvard MBA. He had connections. His section mates worked at investment banks. And since Intuit was so consistently profitable and growing, so number one, he knew venture capitalists, so that they knew him and they were interested. He also did a great job of publicizing Intuit and making sure that people knew that it existed and that it was making money. So he had venture capitalists coming to him saying, we want to invest. Now I don't know for sure which ones he took. I vaguely, this was many, many years ago, so I do not remember the details and don't want to attempt to say anything that I can't really substantiate. But my impression, and I remember hearing at one point, is that he got some of the venture capitalists he got involved were people who knew him personally from business school. And essentially, it's almost like he did them a favor by letting them invest so that he could get some liquidity, versus the business actually needing them involved. Because some businesses go public or raise venture capital because they need the cash flow and they need the money. In this case, my understanding is that Intuit didn't really need the money. Scott wanted some liquidity, so he basically allowed some venture capitalists to invest. Well, once you have VCs in the mix, the only ways that the VCs make money is for you to go public or for you to be acquired. But VCs need some sort of harvest event. So, and this was true. Let me think about which companies I'm thinking of. Actually, I think this was true of every company that I was involved at that went public had venture capitalists involved. So, and I was not part of the executive team at any of these. So, so I would assume that it was the VCs involved who initiated the IPO process. Keep in mind also, by the way, that a vanishingly small number of companies ever go public. It's a widely publicized event, but the chances of any given company going public are minuscule, which is one of the reasons that you really want your company to be fundamentally profitable if you can get it there, because the chances of your being able to go public with an unprofitable to go public at all are very slim, and to go public with an unprofitable company are even slimmer. It just so happens it happened a bunch in recent years because there was so much money that there was a lot of VC involvement. And again, those are the deals that got a lot of press. What you didn't hear about was the 90,000 companies that didn't go public, or the 90,000 that are just successful businesses and don't have VCs involved. And they just, they run the business and they expand when they see the possibility of expansion. And they don't, they're not trying for the big public thing.
Interesting. And speaking of VCs, actually, I read a book called Blitz Scaling at some point. Do you think that blitz scaling is possible without VC intervention, and how does that work?
I couldn't tell you. Interestingly, the one of the co-authors of Blitz Scaling, Chris Ye, is a friend of mine, and he's done a lot of thinking about what it takes for a company to blitz scale. But and I have not read the book, so I can't speak with any authority about the specific term. But my understanding from conversations with him is that blitz scaling is for markets that are winner take all. Markets that have network effects or that have some unusual reason that once they're big, no one will be able to compete with them. And that's not all markets. But if you're going into a market like that, then the sooner you can reach that point of no return, the more it will guarantee that you'll be the one who wins. That those are the conditions under which blitz scaling is most appropriate. I don't know if you have to have VCs involved, because again, I haven't read the book. I don't know what his model is. But if you're going to be growing that rapidly, if you're going to be trying to get a winner-take-all market as quickly as you can, it means that you're going to need to simultaneously scale your marketing efforts and scale your operations. And if you're a manufacturing company, scale the rate at which you can manufacture. I mean, you can't just scale one piece of the business. You have to scale all of it at once. And that's going to take a tremendous amount of cash. Most people don't understand that growth eats up cash. They think, oh, a company's growing. That's amazing. That's incredible. That's fabulous. How could that be a bad thing? And the answer is it could be a very bad thing, because generally speaking, and I'm going to use an example of a physical product, although there's analog with services. If somebody comes to you and says, let's say that you're making, I don't know, ballpoint pens, and somebody wants to order 1,000 ballpoint pens from you, you have to have those manufactured in order to complete that sale. Ballpoint pens take longer to, at the moment at least, they're not manufactured on demand, at least so far as I know. So what that means is you have to buy the raw materials, and you have to have the manufacturing capability, and you have to have the people to run it, all before you've ever made a dime on those ballpoint pens. So that means you have to pay out that cash before you get the cash in. Now, even if you have advanced orders, most people are not going to pay you for the ballpoint pens before they've been manufactured. So if I place an order with you and I say I'm willing to place an order that you deliver in December, and I'm going to place the order with you in January, so you'll have plenty of time to manufacture the pens, I'm still probably not going to pay you for those pens in January. I'm going to say I'll pay when you ship them, or I'll pay when you have them ready. I'm not going to give you a loan for a year to manufacture the pens, which means you have to get that loan from somewhere else. And sometimes you can get a business loan, small business loan, but that's where venture capitalists and angel investors and friends and family investors come in. Is they often provide the financing that you need to be able to ramp up to deliver the higher order volume that you're anticipating next. So if you're in hyper growth mode, if you're in blitz scaling mode, and you're saying, we're going to go from 100 customers to 100,000 customers in the next 4 months, you need to put in all the money that it's going to take to get to get to that 100,000 number. But you need to put that in today. You need to hire people today. You need to train them today. You need to put manufacturing in place. Or if you're a service business, you need to put training in place and figure out how you're going to manage that many people, so on and so forth. And all that money has to be spent up front before you actually get to that 100,000 people. So again, banks will take you some degree of that. But if you're talking about something like blitz scaling, where you're not going to have a substantial track record before you start spending money, pretty much the only people you're going to find who will give you money are either individual rich angel investors or venture capitalists, because that's the business they're in. They're in the business of providing that kind of risk capital.
And with your experience working in Silicon Valley with entrepreneurs, what can you say are the most common mistakes that entrepreneurs make when they're trying to, start their business, let alone grow it?
What I've seen with my own eyes where people go wrong is, one, they have extremely unrealistic ideas of what it's going to take to get a business up and running and profitable. They have read the stories of the people who did it in 3 months, and they go, oh, if this company did this in 3 months, surely I'll be able to do it in 3 months. No, not necessarily. A lot of getting that super rapid product market fit, frankly, is luck. I have seen multiple companies in multiple industries all have exactly the same idea, but they've implemented it differently. And one of them had to go through 3 iterations before they found the combination that would work. The other one didn't, because the other one guessed right the first time. So there is a real degree to which people are overconfident in terms of how rapidly they think that something's going to be able to be successful. Another thing is people celebrate valuation way too much. This obsession with like unicorns and with, oh, how valuable is my company? I don't care what the valuation was at your last round of funding. I mean, the entrepreneur cares, because if they can cash out, they can make a boatload of money. But if we're talking about people creating real businesses that provide real economic value and don't just transfer money from people in the market to to other people's pockets who aren't actually providing any real value in the world, if you really care about real companies, then the metric to focus on is not what's your valuation. The metric to focus on is are you solving a real problem at a price point that people are willing to pay? And do you have a healthy margin so that you can deliver that at as low, but I don't know what the right grammar is. But basically, have you found a product or service that people really want and really want to pay for? Can you deliver it at a price that people are willing to pay and that costs you far less than they're willing to pay, so that you have good, healthy margins there? And do you do it, and can you do it better enough than your competition that you can win in the marketplace, even though there are competitors? And to me, those are the things that you should be paying attention to. Not and the mistake, which was your original question, the mistake that people make is they focus on the wrong metrics. They worry about things like, what's our valuation, instead of worrying about things like, are we profitable? Because you can have a gigantic valuation, as we have seen with and Lyft and Uber, and not make a cent, which means as a business, you're a failure. And I'm pretty clear about that. You are a Lyft and Uber are failures, and WeWork was a failure as businesses. They were not businesses that were being run in a way that made a profit. They were businesses whose primary ability was to take money and transfer it from shareholders into the pockets of the founders, and that they did incredibly well. So as a founder who really wants to create a real business, you want to be looking at your fundamental profitability. You do want to be looking at market size. If you might be fabulously profitable selling $100 million Fabergé eggs, but there's probably not a big enough market for those to support blitz scaling up to 100,000 customers, and so on. So the other thing that I would say is an issue is a mistake people make. It's not paying enough attention to the market and to why people buy the product, what they think they're buying, what the future trends are, etc. A lot of times people just come up with some cool idea and they roll it out, and they never actually stop to think, is this idea addressing a genuine need? And sometimes they can create a need for it. right? If you had asked me in advance, are people ever going to need to walk around taking pictures of themselves and posting them on social media so that people can scroll through and, and look at pictures of strangers in fabulous locations, I would have thought you were out of your mind. But yet somehow Instagram is, it's the thing. And, and in my view, it doesn't actually really provide any value. And I would never have predicted it in advance. But, that just goes to show don't consult me on the viability of your social media ideas, because what's popular and what I think is useful in the world, I would go for something like solving world hunger, and I'd be broke today, and, and who knew that that helping beautiful people take pictures of themselves would be the killer app, but there it is.
Wow. And that's eye-opening. I mean, so in terms of creating a need, how does that usually work? Is that like a play on people's psychology? Is this because humans are not rational, according to Adam Smith? I mean, I still don't understand that whole thing of people creating a need for something that actually never existed and it actually becoming something that is astronomically useful, and then other companies jumping on that boat to actually create other industries out of that.
Sure. Okay. So there are two kinds of needs that companies fill. One are the primary human needs. The other one are the needs that are created by our solutions to the primary needs. So, for example, the example that I was using is we have a need for community. We invent Facebook to fill that need, which I would argue that Facebook fills that need much more poorly than previous in-person communities did. But in any event, we invent Facebook to fill that need, and then we discover that Facebook is really addictive. Now, it's addictive because they developed it to be addictive, but in any event, now that's a problem. Well, now that creates a new need, which is a need for some type of technology to act as a throttle on Facebook, maybe to cut our computer off after we've used it for a certain amount of time so that it doesn't consume the rest of our lives. So that is a technology that has created a new need. You see this, I mean, our entire economy is built on this. The vast majority of products and services are products and services that go into other products and services, right? If I, the end consumer, want to buy a fan, like a table fan, that fan has a casing, that fan has blades, that fan has a motor. All of those may be made by other companies. And so now there's a demand for all of these different elements of technology that need to exist, or that demand is created because those elements of technology need to exist in order for the table fan to exist. So my need to be cool on a hot day has in fact generated all of this other entrepreneurial opportunities for people to put together the component pieces that then get made into a fan. So a lot of and those are other kinds of needs. I don't know what I call those, supply needs. And then there are the needs like the management needs, like I mentioned with Facebook, or things like we invent banks, and banks fill a need, a safe place to store your money. But now we also need accountants because we need to make sure that banks are tallying everything up. So we now create a profession of people who can be accountants and help you do your books for your home business or whatever. We kind of end up creating all these needs that are a byproduct of us getting our fundamental needs met. And, when you say, how do you create a need? I don't know if you can create a need. What you can do is you can create a product and convince people that it fills some need of theirs. And, but I don't think about ride sharing, for example, right?
Yeah.
Ride sharing didn't fill any need that didn't already exist.
Of course.
For drivers to have part-time income, and it filled a need for people to get from point A to point B. But, what one could and fairly successfully argued that if taxi services in America, there's a cap on the number of taxis that are allowed in a geographic area. But if taxis had the cap removed and had it made possible for people to become part-time taxi drivers, it would have accomplished the same thing. The was recognizing that there were these two needs: the need to be a driver and to get use out of your car and make money that way, as well as the need for more local transportation than existed before. And all that Uber and Lyft have done is put the two of those things together. Now, of course, what's hilarious, as I've dunked on them multiple times for not being profitable, it turns out that's not a very good business to be in. There's a reason that most taxi companies are very small, because it doesn't throw off enough money to pay for a large corporate overhead. And the Lyfts and the Ubers of the world have tried to blitz scale, except that blitz scaling requires this gigantic corporate overhead. And the basic economics of car driving, the basic economics of getting someone from point A to point B just doesn't support a large corporate overhead. It can support a small number of owners, and maybe support a small number of owners very, very well, but it can't support a company that has hundreds and thousands of employees. There's just not enough margin built into the business model.
Wow.
So the answer is, I don't know how I would create a need. I might notice a need that people have if I see that people are constantly struggling with some aspect of their day-to-day existence, and then come up with some way to fill that need. But that's a very different thing than saying, I've invented a business and now I want to create a need for it, even though there isn't a fundamental need for it.
Okay. And when it...
Battery level above 70%.
When it comes to managing finances, for example, because we talked a bit about income statements and being able to interpret them and everything, at what point does a business owner stop reinvesting money into the business, or at least stop reinvesting most of the money into the business? Because a lot of the times, someone will start a business with all their savings and things like that, and then, run the business for some time, and then decide, that they want to buy a new car, or, start paying for their personal expenses and things like that. So at what point does an entrepreneur actually, start using the money from the business and paying themselves?
Pretty much if the business is throwing off cash anytime they want to. Now, here's the thing. Remember, I said before, growth eats up cash.
Yes.
So a lot of times what happens is there are businesses that are perfectly good, small lifestyle businesses, but because the owner wants to grow, they keep reinvesting the money in the business to grow it. And they never take the cash out. And then, a lot of times they try to grow bigger than they can, and they can have a very sudden crash if they can't make it over the next financing hump. There's a story that made a big impression on me when I was in business school. We were doing a case study on an entrepreneur who had a company that did something really unsexy. I don't remember what they did, but it was something like they manufactured the plastic tips that go on the ends of shoelaces, right? Like, this is not a sexy business. People are not going to wake up in the morning and go, oh my gosh, I'm so thrilled to work for this company. My mission in life is to create plastic tips for shoelaces. This was a boring business. And it was so boring that there was only one company in the world that did it, which was this company.
Wow.
Which means that they could set whatever price they wanted, because nobody was looking into getting into this business, right? Everyone wanted to be in the super competitive businesses, like doing whatever the technology thing that all the 20-year-olds were doing. And so this guy, I don't remember how big the business was, but it was $40 or $50 million, something like that. And he was taking home $4 or $5 million a year in cash at the end of every year. That was how much money the business was throwing off. And the job of the MBA students, of course, was, if you were in his position, what would you do? So we spent an hour and 20 minutes talking about, if I were him, I would take all that money, and instead of taking it home, I would use it to expand into this market and expand into that market. And I would hire R&D people and try to come up with plastic tips, that are not for shoelaces, but that are for the cords that go into hoodies. And then we could expand out into plastic tipped shoes to wear in the winter, and yada, 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 on and on and on and on. And the guy who owned the company was a guest in class that day. And he got up in front of the class, and the first thing he said when we were done is he said, ladies and gentlemen, what is so bad about me taking home $5 million cash at the end of every year after working maybe 20 hours a week? He's like, why in the world would I want to mess that up? So he was somebody who was deliberately not investing in growth because he had a business that ran just fine. It generated enough money for him. He didn't need any more than that. And he recognized quite correctly that growth would require money. So growth would eat up that money that he was taking home. And also, there was no guarantee that entering these new markets and growing and all of that would actually result in more money to him. He could pour a bunch of money into this and it might go nowhere, or it might attract the notice of somebody who had not ever considered getting into the business of making plastic tips for shoelaces. And they would go, wow, this guy who's trying to get into our industry, it's this plastic shoelace making company. Well, jeepers, we never realized that making plastic shoelace tips was so profitable. Maybe we should just go into that business and become his competitor. So he was staying underneath the radar. He was operating a business that was throwing off enough cash and enough profit to pay everyone who worked there quite well, and for him to take home $4 to $5 million a year. And that was his life. And I'll tell you, I have a very what I believe is a rather controversial opinion about business. I believe that the fundamental purpose of business is to make our lives better.
Of course. I
do not believe that people should. Well, you say, of course. There's a lot of people who would argue with that. What a lot of people would say, the fundamental purpose of business is to make money for the owners, and therefore, any activities that the business engages in that makes money for the owners is automatically a valid reason for the business to exist. And I just disagree. I think there are plenty of businesses out there that's well, I mean, WeWork was a great example. WeWork was a giant transfer of money out of everyone else's pocket into Adam Newman's pocket. And I don't care if it was making a profit, if it was making a profit in a way that was deprived. Well, actually, the Uber and the Lyft might be a better example. When Uber and Lyft lease cars to their drivers, and the financial terms on all of these things are such that people don't realize what a bad deal they're getting. So they end up with expenses that they're paying on their that they're paying on the car rental. They are also ending up paying all of the insurance and all of the maintenance for their cars and all of the operating costs, all of these things that normally would have been covered by the transportation company. And Uber and Lyft have managed to shift all of that burden onto the drivers. And most drivers are not financially sophisticated enough to really know or understand that. But, at the end of the day, if you factor in all of those costs, and they're real costs, a lot of people who think they're making decent money are actually not making decent money because they're going to have to replace their car at some point. And, that's a big chunk of money that is not actually being covered right now, or they're not accounting for it. So my attitude about business is that if a business is net destroying value, even if it's making one individual or an owner a bunch of money, that I would rather see those assets redeployed. Like, I would rather see that business go under and see those assets redeployed into the hands of an entrepreneur who can make an actual profit and compensate everyone in the system at a fair level, right? Another good example of this is Walmart versus, I believe, Costco, right? Costco manages to pay all of their employees a living wage and treat their customers well and make a decent amount of money and be profitable. And Walmart pretty much has a big chunk of their entire employee base living on public assistance and food stamps because they don't pay enough. And I just look at those two examples and I say, look, it is clearly possible, because Costco is a living example of it, to be a big box store and to do it in a way that does not destroy value. Whereas Walmart, despite the fact that they're very profitable, or they're profitable enough to be, to make the Waltons the richest people in the world, or some of the richest people in the world, they're doing that, and they're foisting a big chunk of the cost of their employees onto the public. And I just don't think that's, I don't think that makes sense. So anyway.
I agree with that, actually. This is interesting. Yeah. I like the part of the case study. I watched a video on YouTube of students at Harvard Business School when they were solving a case. Tell me more about those cases. What did you learn from solving case studies, and like from solving those case studies in class? What lessons did you learn when it comes to how important was that when it comes to you solving problems in the real world?
That's a good question, and it's a question that I've asked myself. and I've asked myself a fair amount. The Harvard Business School education itself specifically, I did not have a business background before going to HBS, and I found what it gave me was enough information about the way business operated that I could take my prior analytical skills and my prior thinking skills, and instead of thinking about engineering, which is what I used to do, I could now think about business. And I could think about business using the same rigor that I used to think about engineering. If I had not had the engineering background, however, I don't exactly which elements of the business school program would have been useful and which ones wouldn't, frankly. I still remember very vividly when I first graduated from HBS, I didn't feel like I had learned very much. I kind of walked out of it going, okay, so I had these, hour and 20-minute conversations, and I had 800 of them in 2 years. But if you said, what exactly did you learn? I wouldn't have really known. I would say, well, I guess I know how to read an income statement now. And I can certainly, I can talk about the different sections of a business plan, but other than that, I couldn't tell you. And then I went to work at Intuit in Silicon Valley. And about a year into my time at Intuit, one of my coworkers came to me, and he had a business plan for a company that he was planning to start. He was going to leave Intuit and start his own company. And he said, could you take a look at this business and just tell me what you think? And I started reading the business plan, and I was talking out loud as I was reading it. I was like, yeah, I'm not so sure about your distribution strategy, blah, blah, blah. You're going to be having these competitors and these channels. And the overall strategy itself is really dependent upon foreign exchange remaining below certain levels. And if you look at recent trends, continue at those levels. And you're making the fundamental assumption here that these other types of companies can't encroach on your market. And I'm just seeing it's coming out of my mouth. And I'm going, where is this coming from? Like, if you had said to me, how would you evaluate a business plan? I just kind of look at it and see if it makes sense. And if you would ask me that before HBS, I would have had no idea. And after HBS, I was able to articulate what things I would have in mind. But when actually presented with a business plan, all of a sudden, I was thinking of it in terms of operation strategy, market strategy, competitive strategy, something that I call capability strategy, which is a different thing. I was like noticing, wow, this business you've laid out is going to require the following kinds of people in order to be able to pull it off. But your hiring plan is budgeting for people at a salary level that isn't going to bring in the kinds of people that you need. And it was like I could suddenly see all the different pieces of the business and how they all had to be lined up in order for the business to be able to function, which actually in some ways gets back to the basic math. And maybe my engineering degree had made this easier for me. But I used to do business plan reviews for people, and I stopped because it was too depressing. But one of the first things I would do when someone gave me a business plan is I would just look purely at the numbers and say, in order to hit the numbers that these people think they're going to hit, how many units are they going to have to sell, and at what profit margin? And then how expensive is it to acquire a customer? So if you say that you're going to sell 10,000 units, well, what kind of product is this? Oh, this is a thing that does enterprise-wide databases. Okay, you're going to sell 10,000 units. What does the product sell for? It sells for $500. Okay, you're going to sell 10,000 products for $500, which is $5 million total. And it's an enterprise sale, so it requires an individual working on it. And you would say the total amount of time that it takes somebody to make one of these sales is 100 hours, blah, blah, blah. You do the multiplication and the math, and what you discover is given the set of constraints you just gave me in the business plan, which is that you're an enterprise sale and it requires a customized sales conversation and that your pricing is $500, like you can just do the math and figure out that there's no way that's sustainable because you can't afford to hire the people to make the sales given the amount of profit that you're planning on making per sale. Like the numbers just don't add up. Yeah. So I would say that 60% of the business plans that I look at fail that test. We don't even have to get into distribution. We don't have to get into, does this meet a real need? It's very clear that the entrepreneurs haven't even thought through the numbers enough for them to be consistent. Now, the other stuff, and if you talk to a lot of VCs say, we know that the financials are bullshit going in. Except there's two different kinds of bullshit. One is someone being ridiculously over optimistic and saying, we're going to make $5 million in 2 years, or $50 million in 2 years, which is very difficult to do. That's one type of bullshit financials. But the other type of bullshit financials is someone literally doesn't even know what the numbers mean. And they just put a bunch of numbers on a piece of paper. And I've worked with entrepreneurs like this, where these are people who didn't have a financial background. So they got some book, which was how to write a business plan, and they just copied the financials, complete with the numbers. And I sat down with an entrepreneur and I said, you're showing that you have $100,000 of income in the first 6 months of 2019. Well, it's June of 2019. How much income have you had? He's like, well, $10,000. I'm like, okay. So you literally have handed me financials that don't even reflect what you just told me. Like, where did you get this 100,000 number given that you've only had 10,000 in sales? And he said, oh, I copied it. And one could say, oh my gosh, this person's trying to commit fraud. It wasn't fraud. He didn't even know what financial statements were. As far as he knew, the numbers were just made up. No one had ever sat down and walked him through. This number has to actually reflect a certain number of customers buying at a certain price, et cetera, et cetera. So that's the kind of learning that the HBS education produced in me. And again, it didn't do it with an engineering education, which was my MIT education. With an engineering education, they know exactly what they're teaching you, right? You take a class in digital signal processing, or circuits and systems, and that's what they teach you. And at the end, that's what they test you on. HBS does not teach business by breaking it down that way. It breaks it down into broad categories. We have a class on marketing, we have a class on finance, but the way that the case method works is you bring all of those different specialties to all of the cases in all of those classes. So you can always be bringing in things. There's a big debate. Harvard claims that what they teach is general management. They teach you how to be the manager that oversees the entire enterprise, right? The CEO perspective. And that's the only manager actually in a company. A general manager is the only manager that actually has to oversee how all of the pieces fit together. Every other manager only has to oversee how their particular pieces fit together in their particular functional area. And there are very many general managers in a particular company, but it's not an easy thing to teach because you need to know enough to know how the pieces fit. But of course, you can't be an expert in each one of the pieces, and in fact, it's probably not useful to be an expert because then you run the risk of getting caught in all the details, and you don't want to get caught in the details. If you're the person running the whole shebang, you want to be able to have a big picture strategic. The big picture, strategic picture, at least as you grow. I mean, when you're a 4-person business, yes, you're going to be caught in all the details. But as you grow, if you are scaling, and that is technically our topic, if you're scaling, you need to be able to have the big picture and know how things interrelate, which is what HBS specifically bills themselves as doing. And there are people who doubt that can be taught. My experience is that I came in understanding only one function, which was research and engineering, research and development. And I left, I think, having a pretty solid understanding on, kind of all aspects of the business. And in the years since then, because I had at least a cursory understanding of all the different areas, I've been able to be in situations where I needed to go deeper on one or more areas. And over time, I've deepened my understanding of all of the areas of a business. Right? I mean, at this point, I know more about designing compensation systems than I used to. I know more about HR and than I used to. I know more about operations than I used to. I know more about finance than I used to, and I know how they all fit together. So that to me was the big pictureness. The basic education, useful, yes, but the big picture, how all the pieces go together, that to me was the thing I walked away with. That in advance, I would not have even. If you had said, what are you going to get out of the MBA? That would not have even been on my radar screen because I didn't even know that was a thing to get. Does that make sense? Or am I just babbling to hear myself talk? Like I can't always tell.
Okay. I think we'll wrap up the conversation. Yeah, the rest we'll have it in the other two sessions. This was actually amazing. I like how you actually shared more than what I asked, and I can actually play this conversation again and actually write some notes as well. So that was the conversation I had with Stever Robbins. In the next session, we're going to continue unpacking the fundamentals of building startups as well as managing startups as well. And I hope that this conversation was as insightful to you as it was to me. Stay tuned for more episodes. Don't forget to go and follow my page on Instagram at thebusiness_diary, and also find the podcast on all streaming platforms. So that's Spotify, Apple Podcast, Google Podcasts, any streaming platform that is out there, you will find our podcast there as well. Thank you so much for listening, and have a good week.